Welcome back, everyone. And today, I want to talk about why it can sometimes feel like you're falling behind when it comes to wealth building in the stock market. And then I actually want to give you some practical advice that you can start using today that'll help you generate even more money. So I want to be real. Most people, I feel like at some point, have felt like they're falling behind in investing. Maybe you've been sitting there thinking, man, I should have invested earlier, or I should have bought that stock when it was cheap. Or maybe you're even thinking that you should have invested more money by now. Or hell, maybe your only exposure to the market has been in an S&P 500 index, which is fine, but I get it that this can sometimes feel like the slowest way to build wealth, while others are zooming past you. Here's the thing though, falling behind is usually the result of three things. You don't have enough money invested, you didn't pick companies that could actually change your financial future, or you've been playing it too safe, expecting slow and steady returns to magically turn into massive wealth. And yeah, I totally get it, because most financial advice tells you just to keep stacking index funds and be patient, which is extremely safe. But if you're starting with a smaller portfolio, safe might not be enough to get you where you want to be in the timeline that you're hoping for. But there's honestly really good news for you, because you can catch up, no matter where you are, if you approach it with a better framework. So let me give you the first practical solution to building wealth. You need to get out of the random portfolio mode. You see, I think most investors own way too many stocks that they don't understand. It's basically just like collecting stocks for the sake of collecting them and filling up a junk drawer full of stuff that you might use one day. And the problem is that when you don't understand companies deeply, you won't have the conviction to hold them through volatility. Instead, you might trim winners too early, keep losers too long, and basically end up with average results. So what I do differently is focus on a smaller number of companies that I really understand, companies that have the potential to 5 or 10x. Because when you truly believe in the business and its trajectory, you size in a way that actually moves your portfolio forward when it wins. Now, for practical solution 2, you need to think in asymmetric bets. So what I mean by this is, if you feel like you're behind, you need the possibility of a huge upside, without gambling of course. And this is where asymmetric bets come in. You're looking for companies where the potential reward is far greater than the downside risk. I'm talking about finding opportunities where one right move can accelerate your portfolio years ahead. I did this with Palantir when it was $5 a share, and it 10x'd my money in about 2 years. That kind of return in just one holding can change your entire portfolio's trajectory. And this doesn't mean that you're chasing hype stocks. It means that you have a process to identify early stage winners with real moats and future demand. And lastly, for practical solution 3, you need to have a conviction framework, because the market will really test you. Every time a stock drops 30%, your brain will scream at you to sell. And every time it's up 100%, you'll be thinking about taking profits. But without a framework, you're just reacting. The way I like to approach investing is by deeply evaluating leadership, market timing, and long-term moats that companies build before I buy. So when the stock starts to get volatile, I already know exactly what I'm doing and I have a plan. And that's honestly the difference between building wealth and constantly resetting to zero. And here's the truth. Feeling behind isn't permanent. It's just a signal that your current approach isn't aligned with your goals. So if you start building your portfolio around conviction, asymmetric upside, and a smaller set of companies that you truly understand, you can make up years of lost time way faster than you think. You see, most people will stay stuck in index fund autopilot, hoping that slow compounding growth will be enough. But if you really want to accelerate your wealth building in a safe and practical way, you need to be intentional about the companies you own and the roles that they play in your portfolio. But it really doesn't have to be complicated. In fact, the lazier you are with your approach to investing, the better. And if that sounds counterintuitive, it's really not. Watch this video next to learn how I've applied the lazy method to generate an average return of 100% per year over the last 5 years in the stock market. Anyway, thanks for watching, and I'll catch you next time.